fundamental terms, I should say, the dollar looks already pretty cheap. And we're clearly driving it down by aiming to increase inflation and swamping the system with money. Why wouldn't emerging countries take defensive action? And all of them are. So we're already in a currency war, in a way. It's a mild one, and I hope it stays that way. But a currency manipulation is exactly the same as tariffs. It's a bit easier to change, a bit easier to back off. But it has the same effect on global economy if we get into a currency war as if we got into a tariff war, which characterized the period after 1930 when the Smoot-Hawley tariff bill was passed. And they're talking about that even as we speak in Congress.
So while so many people are talking about the Chinese as far as manipulating their currency, you say the Fed is manipulating these markets.
They are. And China is, of course, manipulating its currency, and it would make life easier for everybody if they would allow the currency to rise a little faster. But it certainly weakens our hand enormously to go there and shout at them angrily when we're clearly doing the same thing. And this is what the German finance minister, the point he made 2 days ago.
Right. Let me ask you about emerging markets. You recommended an overweight position in emerging markets back in 2000 when not many people were talking about it, and obviously it was dead on the right call as we've seen a huge move in the emerging markets. Do you think there's still room to run in the emerging markets, or is that becoming a bubble?
Incidentally, the emerging market since 2000 is 3.3 times the S&P. So every $100 you have in the S&P, you would have had 330 starting from the same point in emerging. And after that incredible discrepancy, which, by the way, says the main event in investing should be getting the big picture right. It's nice to pick stocks, but how many good stocks do you have to pick in a whole portfolio to equal that incredible move between the biggest asset class in the world, U.S. equities, and the third or fourth biggest asset class, emerging markets? It's these movements between the great asset classes that make you money. And I'm happy to say that's the group at GMO I work with, asset allocation, where we are students of bubbles and basically financial history. It's a very entertaining job, I might say, which has made me forget the question.
The question is, do you think that is now becoming overvalued? Is there still room to make money in emerging markets?
I'm pleased to say 2.5 years ago I did a quarterly letter called The Emerging Bubble. And I argued that in the following 5 years, the case for emerging would be seen as so crystal clear that it could not possibly help but outperform and go to a premium PE. Now, up until then, they had always sold at a discount, sometimes a substantial discount. But the case is this. They are growing at about 6% real, 6% plus inflation. We're growing in the developed world at about 2%. Before 95, there was no difference, before 1995. And now it's 3-1. My argument 2.5 years ago is, what a simple bull case. You want to grow? Buy emerging. You want to be conservative? Buy utility companies or the blue chips of the developed world. If you're going to grow at 6, it is very appealing that you would outperform a world growing at 2%. And the developed world is slowing down. I say it has an incurable case of middle-age spread. It's just been there, done that. It's a little old. It's a little past it. Doesn't have the population profile. Emerging does. And they have the attitude, and they have good finances, and they're really showing a clean pair of heels to the developed world. Now, it turns out that it's a bit more complicated. You don't actually find a strong correlation between top-line GDP growth and making money in the market. It seems like you should. The fastest-growing countries should give you the highest return. They simply don't. But there's only 4 of us that believe that story. Everyone else in the world believes that if you grow fast like China, you'll outperform in the stock market. And so I'm reasoning 2.5 years ago, everybody will think this way pretty soon, and surely emerging countries will go to a big premium on every dollar of earnings that they make, and they're beginning to. But I think they've got at least a few years left. The bad news for us, because we're fairly purist value managers for mainly institutional clients, is we don't like to play games with overpriced assets. And that's the world that we're in now. The Fed is driving the S&P, which is overpriced, the Standard & Poor's 500, a broad measure of the U.S. market. It's driving it from already substantially overpriced into what I would call dangerously overpriced. This is about the boundary line. We expect on a 7-year horizon 1% only plus inflation from the U.S. market. And now as you push it up another 20% perhaps in the next year, it becomes dangerously overpriced, a bubble territory, and ready to inflict considerable pain. That's what we have to worry about. So you're caught between, if you want to be conservative, you've got to start taking counteraction now. If you want to go with the flow, don't fight the Fed, as they say, you should be prepared to speculate on very nimble feet. It's not our style as a firm, but I think it's probably a game that you could play with a pretty good chance of winning for a few more quarters.
A few more quarters, but at some point, or is it today, would you be recommending selling into the rally?
Our institutional clients sell very gracefully into this rally. We've already started to sell. We're not even averagely weighted. We're modestly underweighted. And you must remember, bonds are even worse than stocks on a 7-year forecast. So you get caught in this paradox. It's very tempting, and this is what the Fed wants, by the way. It wants us to go out there and buy stocks which are overpriced because bonds they have manipulated into being even less attractive. So we're being forced to choose between two overpriced assets. That is not always a terrific choice to make, because there is a third choice, and that is don't play the game and hold money in cash. And cash has a virtue that people don't appreciate fully, and that is its optionality. In other words, if anything crashes and burns in value, say the U.S. stock market, if you have no resources, it doesn't help you. If the bond market crashes and you have no resources, it doesn't help you. And what cash is an available resource. It buys you the right to buy the U.S. market if the S&P drops from 1,220 today to 900, which is what we think is fair value. You then have some resources if you have some cash. There's another complexity, and that is we believe that the old-fashioned super blue chip franchise companies like Coca-Cola are also much cheaper than the rest of the market. So if someone put a gun to my head and said, I've got to buy stocks, what should I buy? I'd say buy 2 units of the Coca-Colas. They're the cheapest group in the equity world. Buttress it with a fairly large dose of emerging markets. They're a little overpriced, but they've got potential, and a lot more cash than normal for opportunities should the bubble blow up.
What about commodities? I mean, clearly the story of China and the demand coming out of China has boosted all sorts of commodities. Is that bull run still in place?
I have an eccentric view on commodities, not necessarily shared by my colleagues or by almost anybody, and that is we're running out of everything. I think it will become devastatingly clear to everybody. I think we went through a great paradigm shift about 5 years ago, and we'd spent 100 years with almost all commodities declining. Perhaps oil was about flat in real terms, adjusted for inflation, but everything else was declining, copper, corn, and so on. And now you look back 5 years later, you can't see that clearly at all. A lot of them seem like they've been going up for 50 years, 100 years, copper, iron ore, tin, and oil. Oil is clearly broken out. It spent 100 years at $16 in our currency until 1974. And then it doubled when OPEC started, and it spent 20 years trading around 35 plus or minus a lot. And then I think it doubled again, and I think the trend line is probably about 75. So the world has changed. We're entering a period where we're running out of everything. The growth rate of China and India is simply can't be borne by declining quality of resources. And I think we're in a period that I call chain-linked crises in commodities. So it'll be a crisis in rice, it will triple, then it will come down, but then it'll be followed by one in corn and barley and so on. And copper will go up a lot, and then that will come down, but oil will be in crisis mode. From now on, we just better get used to it. So if you're afraid of inflation, I think, and if you can bring yourself to have a long horizon, and when I say long, I mean 10 to 20 years, not the usual 10 to 20